Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we start off this week with a pretty bearish tone here overall to the markets. As you can see over the last month or so, we have the S&P 500 break down below some major support levels. The first one being that 675 level that has been holding since sort of December as some minor support multiple times. We saw that break here at the beginning of March. Traded all the way down to the major support level here at 650, which was a level going back all the way to September of last year, which after a quick bounce sort of at the end of March, we started to break below here at the end of last week. And that was essentially the market slowly losing confidence that the conflict in the Middle East was going to be a quick one that was going to be measured in weeks, now looking like this is likely going to be some type of conflict that is going to last potentially for months, unless somehow either side were to give in, if you will, to the demands. And overnight, and over the last few weeks, we certainly have seen rhetoric be a driver of intraday sentiment that would last maybe somewhere between 24 to 48 hours before the reality of this conflict settles back in, where the picture becomes relatively clear that at the pace that it's going right now, this is not likely going to be the type of conflict that gets resolved in 4 to 6 weeks. And predominantly, this everything is revolving around the flow of oil through the Strait of Hormuz. You essentially have 20% of the world's global oil supply trapped as a result of the Strait of Hormuz being closed. And just to put that into context, the last oil embargo, which was 1972, which was a oil-driven inflation spike that put the global, or at least the US economy, into a stagflationary environment, which is where we're facing right now. That was roughly 9% of the world's oil supply that affected back in 1972. Right now, we're talking about 20%. And that was before the Houthis sort of joined the conflict, which sort of happened, if you will, over the weekend, which starts to put oil that flows through the Red Sea into risk as well. We saw Saudi Arabia over the weekend, or right before the weekend, say that they've essentially maximized or utilized 100% of their east-west pipeline, essentially trying to move oil out of the Strait of Hormuz over to the Red Sea. But now that is at risk with the Houthis joining in on this conflict. So there's this is all driven off of oil driving the concerns around inflation. You combine that with the fact that the labor market has seen a significant deterioration this year. You have what sets up as a stagflationary environment, slowing growth, yet inflation driven, a spike in inflation driven by oil prices at the moment. You have gasoline that's now nationally above $4. You have WTI settling above $100 for the first time since the conflict. Yet at the same time, overnight, we saw the headline that Trump is essentially willing to end this war even if the Strait of Hormuz stays shut, which is a pretty significant concession the US is making on negotiating a resolution to this conflict. And maybe that is the answer to this, but if the Strait of Hormuz remains closed, whether or not there's any fighting or a ceasefire, I would argue is really not that important if the Strait of Hormuz remains closed, because the if you look at the energy market, it is while equities seemingly today is responding positively to that news. You have SPY pre-market opening up somewhere around 640 right now. So we're talking about, a little over 1% upside on the open today. But we've seen a lot of that over the last few weeks, where essentially on the back of some rhetoric from the White House, we have a roughly 1.5% move here over, 24 to 48 hours, only for the, again, like I said, the reality to set in, which is the fact that 20% of the world's oil supply is trapped and the market subsequently sells off. So what I'm hearing from the news today and the market's reaction to it, being up about 1.25%, doesn't really change the facts of what is really driving sentiment right now, which is oil, which translates into stagflation. Um, Short term VIX you see is down a little bit here. Looks like we're opening up around 28% from the 30 what we saw at the beginning of yesterday. But if you look at the oil markets or the physical markets in oil, it is not responding to what we're hearing right now out of the White House. You have WTI for the first time settling above $100. You have a significant backwardation between the front and back month on WTI. We're talking about $17 of difference between the front and back months of the futures market. Brent, same thing. You're seeing the same type of backwardation on Brent markets, and you look at a lot of these energy importing countries. So, countries that rely nearly 100% of their energy on imports, at this stage, exploring all types of strategies to sort of soften the blow of oil prices, including if you look at South Korea, they're thinking about mandating a reduction in car usage. You have the Philippines exploring certain policies to reduce the demand for oil. The physical market is showing a significant amount of strain that doesn't reflect what we're seeing in terms of any type of optimism that the equity markets are showing right now. So while I think that it is, what's the right word? I think it's interesting to see or it's good to see the equity markets respond positively to the news coming out of the White House overnight. I think we have to look at the oil markets to have a much better sense for what is the true impact of that on the grand scheme of things, because you have the Dow, you have the Nasdaq, you have you have the Dow and the Nasdaq that have now moved into correction territory, so more than 10% from its highs. Um, this is really what's driving overall sentiment. The S&P is not quite there yet, but we're just a couple of percentage points away from getting to that correction territory. We see the Qs this morning also bouncing a little bit on this news. Qs up about similarly 1.2% so far pre-market, but the Dow, the S&P, the Nasdaq, all meaningfully below its 200-day moving average at this point. So any bounces at this stage below the 200-day moving average, I unfortunately still see as a opportunity to seek some further downside exposure. The stagflationary environment that we find ourselves in is a really tough spot where the Fed essentially can't really do anything. Um, we have we have a market where even a few weeks ago, or let's say a month ago, markets were expecting potentially a rate cut sometime between June and September of this year. Right now, expectations for rate cuts have been pushed out to December of 2027. So we're talking more than 18 months out before we expect another rate cut. And this is on the back of what is a deteriorating labor market? Like inflation, the expectations for inflation are so sharp that despite the significant deterioration in the labor market, we still don't expect any rate cuts until 2027. If anything, we were even talking about is there going to be a need for a rate hike? If you look at the CME Fed tool right now, it is expecting there's now assigning anywhere from a 15 to 20% chance of a rate hike sometime later this year. That was a near certainty that we were not going to get a rate hike anytime this year. So things have shifted rapidly. Um, higher interest rates. You have the 10-year yield that's now above 4.3%. It did get as high as almost touching 4.5% just a couple of over the weekend. It has eased back to around that 4.3% right now. But, my concern is that as it kind of reaches back to this 4.3% level here, it still has the opportunity to rise back towards that 4.5%. And that significantly changes the calculus for a lot of smaller cap companies that have we expect a few $100 billion amount of debt that needs to be restructured in 2026 and 2027 that were at this stage expecting interest rates to be about at least 50 basis points lower than where we are right now. And that's going to change the calculus on expectations for potentially bankruptcies this year. Um, we have about 2.2 to 2.5 trillion dollars in private credit. That's a fairly opaque part of the market right now that has been a result of the 2008 financial crisis, where there is a significant amount of debt that's coming to need to be restructured in the next couple of years that are going to be facing some issues from an interest rate perspective. And this is all, things that we need to factor into our views for the broader markets right now. And looking at the way that the equity markets are responding, the outlook at the moment still remains fairly bearish. In my opinion, that the rhetoric that we hear out of the White House, the concessions that the White House is making now, despite the threats it's made over the last few weeks, it does not seem to be enough to improve the confidence of equity investors. If anything, the price action over the last 3 or 4 sessions kind of shows us otherwise. So the major levels to really be paying attention to here right now on, for example, the Qs is let's say this 580 level. If we can get back above 580, that would be a first sign that maybe equity investors have a little bit more confidence in a resolution in the Middle East. But like I said, I think the most important market that we should be focused on right now is actually the energy market, the oil markets. At this moment, really energy and maybe some physical commodities like gold and silver are going to be our primary areas of focus on the long side and within equities. So if you look at XLE, almost any swath of the energy market has been a strong performer here in this market, and our expectations is that in the short run, that will likely continue. And then specifically within the oil markets, if you look at the Chevrons and Exxons of the world, those are, you can think of those as, integrated oil stocks like Chevron, Exxon, those types of stocks. They tend to be really just a leverage play on oil prices, right? Versus if you look at something like Schlumberger, oil field services, these are the companies that provide sort of the drilling equipment. As you can see, they have not been a strong performer. They certainly have not been as strong as, the Chevrons and Exxons of the world. But, companies like Schlumberger are going to be, in my opinion, probably more durable in the grand scheme of this rally. Meaning as oil prices rise and oil companies around the world decide that they are going to perhaps explore oil fields that perhaps were not economical at when oil was at 60, but is economical when oil is at 100, 110, they need to trigger oil drilling equipment companies like Schlumberger to to access that oil. Not to mention Venezuela potentially coming online for U.S. oil companies in the next uh, call it 6 to 12 months. Companies like Schlumberger will have a more durable outlook versus Chevron, Exxon. If let's say there is a resolution to what's happened in the Middle East and oil prices come crashing down quickly, something like Chevron or Exxon will also see a very sharp collapse in their stock price over essentially a short period of time versus something like Schlumberger will be more durable because decisions to drill, those are longer lasting decisions, less correlated to intraday oil prices. So, that's how you generally want to think about when you're investing within the energy space, what type of company you want to buy within XLE. The other place to really be looking at this moment is gold and gold miners. So if you look at GLD, now the difference right now with GLD and sort of gold is the fact that gold has had such a strong run here in the last 6 months that we've seen some of that excess, if you will, collapse over the last month or so, and more so specifically in the last couple of weeks, we've seen that collapse, in gold prices from, nearly $500 on GLD all the way down to 400. But from my perspective, that's probably a better entry point, right? Because if you look at kind of the long-term trends, right? Long-term trends of gold, as you can see, was already steady and up to the right, but it kind of went a little bit too crazy, a little bit too parabolic. And so what we've got is a bit of a retracement back to that trend line, and that, in my opinion, is a better entry point long term for gold. And especially when you think about a stagflationary environment, gold was one of the best performing assets during 1972 stagflationary environment. And again, you would be forgiven to not remember or know the playbook for stagflation because the last time it happened was in 1972. And the last time it happened was because of an oil embargo out of the Middle East that disrupted 9% of the oil supply. Back then we saw oil prices triple. A 9% disruption in the oil prices caused oil prices to triple. Right now, oil prices are up 60, 70%, right? But 20% of the oil supply is being trapped right now. And the only reason that it's only up 60 to 70% is because the market is still holding on to this hope that the conflict in the Middle East is going to be resolved in a matter of weeks, not a matter of months. But that, like I said, that reality is slowly eroding, and that's what we're seeing kind of play out here in the equity markets. And it's really hard to predict what is going to happen in the Middle East. Everyone seems to have an opinion on it. From my perspective, I think the most important thing to look at here is the physical oil market and how that's responding. And at the moment, it is not responding to the rhetoric coming out of the White House with regards to any type of ceasefire or threats against Iran because it is focused purely on how much oil is being disrupted, how long it expects oil to be disrupted, and at the moment, based on WTI closing above 100, Brent at 107, the physical market simply has not responded to sort of the rhetoric out of the White House and that I think is going to eventually be reflected back into equity prices, despite the fact that markets are sort of optimistic this morning, being up over 1%. But I see that at 1% as more of an opportunity to add more to that bearish exposure rather than seeing this as a dip buying opportunity in equities. We just don't see the physical market respond enough in order to justify that dip buying opportunity from equities at the moment. So otherwise, outside of energy, outside of the mining stocks, you pretty much see a sell-off across the board here. Technology obviously being one of the worst performing sectors, industrials, consumer discretionary, those are going to be where you're going to see the most downside in this type of market environment. And, from a bearish perspective, that's really where I would focus sort of my attention here right now. This is an extremely fluid situation out of the Middle East. It's not particularly easy, in my opinion, to stay on top of because a lot of the things that you need to kind of track may not be what you're used to tracking from an equities trading perspective. But like I said, the oil markets, specifically the futures market, and the difference between the front and back month, the size of that difference is a very important metric to be tracking right now that gives you a sense for whether the physical market is showing any signs of optimism or ease to what the conflict that's happening in the Middle East. And, what we saw was after the first couple of weeks where markets were very volatile, there was kind of hope that things were going to resolve quickly. And over the last couple of weeks, that hope has just slowly eroded, and you see it in the physical oil markets, and that is slowly being propagated into the equity markets right now. So that's my thought process on how I'm viewing the markets here right now. The fact that the equity markets are in correction territory leads me to believe that there's a much higher risk that we start leading to potentially a bear market territory. That's where we are down 20% or more in the Dow and the Nasdaq. I think that at this stage, that is more likely than markets kind of seeing this as a buying opportunity and essentially getting back to prior highs. I think the risk of that is pretty low. We do have Good Friday this week, so um, I'm trying to see non-farm payrolls for March. It looks like it is still being released this Friday, even though we have a market holiday this week, at 8:30. That's going to give us insights into um, the job market, because right now there's no doubt that inflation is going to look hotter than expected as a result of oil prices being significantly higher. The question is whether that February jobs report that came in substantially lower than expected was a bit of a fluke or the start of a broader trend of a slowdown in the US labor markets. And the March jobs report, I think, is going to be a big indicator of that. So that would be probably the most important other metric that I would be focusing on this week is the jobs report coming out on Friday morning. Because a slowing economy is certainly not good from a stagflationary environment, but that is probably the one potential off ramp that I see to all of this is if the Fed, especially you have a new governor coming in, a governor that potentially is more dovish overall. There could be the argument that's made that the Fed, despite the stagflationary environment, will cut interest rates to stimulate the economy. There's obviously the risk that triggers a significant hike in inflation, but there is sort of some market participants that are being optimistic that the Fed, if the labor market deteriorates enough, will essentially focus on that more than the inflationary environment and cut interest rates, and that could be a release valve for the current market environment and stimulate some stability and potentially upside in equities, but more so probably stability in my opinion. So that is another sort of other metric outside of what's currently happening in the Middle East and the oil markets that I think are that we need as investors to be paying attention to very closely. Inflation, labor market, energy markets, those are kind of my key areas of focus right now to inform my broader views from the equity markets perspective. So with that, that covers what I wanted to share with you here today. I hope that, this is a helpful debrief of what's happening here in the equity markets in the broader macro sense and how to navigate it through this volatility. I wish you all the best and a great trading week, and I'll see you guys here next week on our Tuesday morning session. Thank you so much and have a great trading day.